$4.4 billion. Let's just pause on that for a second. That is the massive enterprise value of the upcoming combined company being formed by Axcelis Technologies and Veeco Instruments. Right out of the gate, we're talking about a staggering figure that sets a tone of sheer corporate dominance in the semiconductor equipment space. Now, why does this actually matter to us? Well, the chips powering your smartphone, your car, those massive AI models you use every single day, they all rely entirely on the manufacturing equipment these giants produce. It's a scale designed to aggressively tackle the future of AI and power solutions.
But hold on, you've got to contrast that mega merger optimism with this stark reality. 67.8%. That is the brutal year-over-year drop in Axcelis' net income for the first quarter of 2026. We are looking at a sudden, massive plunge in profitability right on the eve of a historic deal. It's an incredibly jarring juxtaposition, right?
So, welcome to this explainer. Today, we're untangling the central paradox surrounding Axcelis Technologies. Because how exactly does a company ink a multi-billion-dollar transformational merger while simultaneously navigating a severe profit squeeze? We're exploring a really fascinating corporate crossroads today. And honestly, the stakes for the global semiconductor supply chain couldn't be higher.
Here is our roadmap for today. First, we'll cover the Veeco-Axcelis mega merger. Second, Axcelis Q1 2026 financials. Third, the bearish margin compression. Fourth, the bullish growth narrative. And finally, looking ahead to integration.
Starting with Section 1, the Veeco-Axcelis mega merger. Let's look at the strategic foundation.
The strategic ambition behind this move is just massive. By joining forces, they're essentially creating the fourth largest U.S. wafer fabrication equipment supplier. It expands their total addressable market to well over $5 billion. Technologically speaking, it's a perfect marriage. You've got Axcelis' absolute dominance in ion implantation meeting Veeco's MOCVD capabilities. They are perfectly aligning themselves to ride the massive secular tailwinds of AI and power device demand. And financially, they're projecting $35 million in annual run rate cost synergies within just 2 years.
To put that scale into perspective, $1.7 billion. That's the combined pro forma revenue these two standalone companies generated back in 2024. So this isn't a defensive move. This isn't about survival. This is about assembling a semiconductor equipment powerhouse with the financial muscle and R&D scale needed to aggressively accelerate next-generation chip manufacturing. Moving to Section 2, Q1 2026 financials, the standalone reality.
Now, bring your attention to the net income. It literally fell off a cliff. We're talking a plummet from $28.58 million in early 2025, straight down to just $9.21 million in Q1 2026. Now, it is absolutely crucial to note that their general and administrative costs rose materially during this specific period, mostly due to heavy merger-related fees. But at the end of the day, regardless of the cause, a 67.8% drop is a massive hit to the bottom line that completely demands our attention.
And this creates a classic financial squeeze. Top-line revenue actually ticked up slightly by 3.3% to almost $199 million. But then look at the earnings per share, down 65.9% to just 30 cents. So the takeaway here is that while Axcelis is still successfully moving products out the door and pushing revenue slightly higher, their ability to actually convert those sales into profit has been severely compressed.
If we break down exactly what systems they shipped in Q1 2026, it looks like this. 32% went to DRAM memory, 35% to power devices, and 33% to mature logic and other applications. Why should we care about this mix? Because different chips go into totally different end products. That means they carry vastly different profit margins and face different cyclical demands. Having heavy exposure to the memory market right now just isn't as lucrative as it has been in the past.
Section 3, margin compression. Let's dig into the bearish view. Trace this timeline with me for a second. In late 2024, Axcelis was boasting a really healthy 19.7% trailing net margin. A year later, that slipped down to 14.3%. And now, based on these recent earnings, bearish critics are projecting margins could compress all the way down to a pretty concerning 8.4%. That downward trajectory really suggests that sustaining their historical profitability is getting increasingly difficult. So what exactly are the skeptics pointing to? Well, there are a few glaring red flags. First up, China. Back in 2025, China made up a massive 42% of their revenue. Today, that market is totally flattening out. Second, That heavier mix of memory systems we just talked about is actively weighing down their non-GAAP gross margins. And third, insider selling. CEO Russell Lowe recently sold over 7,400 shares for roughly $1.17 million under a trading plan. And look, while that's fairly common, insider selling during a period of serious margin compression is always going to raise some eyebrows. Section 4. The bullish growth narrative. The counter-argument.
So while the bears are definitely sweating over these current margins and the China risks, the bulls, they're looking much further down the road. They are hyper-focused on the multi-year silicon carbide adoption cycle and this absolutely explosive demand for AI infrastructure power devices. The bullish camp firmly believes that these massive long-term tailwinds will easily overpower the short-term profit pain we're seeing right now.
In fact, the bulls will point directly to valuation, 40.5 times. That is Axcelis' trailing price-to-earnings ratio. For the optimists, this looks like a relative bargain, especially when you step back and compare it to the broader U.S. semiconductor industry average, which is trading way higher at 53.7 times. They're basically arguing that the market is overpenalizing Axcelis for a temporary dip.
And what really gives those bulls confidence? Record aftermarket sales, $72.6 million in Q1 alone, making up 36% of their total revenue. This is such a crucial detail. See, while massive system sales might fluctuate wildly quarter to quarter, this high-margin customer support and service revenue acts as a steady anchor. It provides vital stability to their top line when things get choppy. Section 5. Looking ahead to integration, approaching late 2026. Despite all these margin pressures, they are absolutely not slowing down on innovation. Take the Purion H6, for example. That's their next-generation high-current implanter that they recently launched at Semicon Korea. It's specifically engineered for advanced device scaling. This just proves that Axcelis is continuing to invest heavily in R&D, making sure their tech portfolio remains totally cutting-edge for the combined entity in this new AI era. And here's where things get even more interesting. Looking at their immediate guidance for Q2 2026, Axcelis is projecting 90 cents in EPS and $205 million in revenue. Now, despite that Q1 stumble we talked about, this guidance actually beat analyst expectations. Revenue is projecting up, and the EPS is forecasting a really sharp recovery from that 30 cents we saw in Q1. It adds just another layer of complexity to this entire crossroads. So, zooming back out to the macro picture, here are the final steps before Axcelis completely transforms. 1. Secure regulatory and shareholder approvals, which is always a hurdle in these massive tech deals. 2. Officially close the VECO merger in the second half of 2026. And 3. Launch an entirely new company name and ticker symbol. The standalone Axcelis story is literally entering its final chapter right now. Which leaves us with this ultimate question to ponder. Will the massive R&D scale and the promised $35 million in cost synergies from this mega merger outpace the fierce margin pressures currently squeezing the standalone company? It is a super high-stakes balancing act between future potential and present reality. Will this mega merger truly redefine the global chip supply chain, or will those margin pressures crack the foundation before they even get started? It's a storyline we're going to be watching very closely. Thanks for joining me for this explainer, and we'll see you next time.